Hello and welcome to the day ahead. It is Friday, June 17th. I'm Andrew Gagan. To the action on markets overnight, and Wall Street closed sharply lower off the back of the Fed's largest rate hike since 1994 as fears of recession rattle investors. And the central banks of Switzerland and the UK follow the Fed's lead, doing little to curb concerns of a dramatic global growth slowdown. The Dow tumbled more than 2% falling below the psychological level of 30,000 points. The tech-heavy Nasdaq fell more than 4%, while the S&P 500 ended around 120 points down. Energy and consumer discretionary sectors falling more than 4% each. Stocks specifically, Apple, Microsoft and Tesla were among the biggest losers of the mass sell-off as investors dumped growth stocks. Wells Fargo led the losses for the US banks. Meanwhile, Walmart, General Mills and Procter & Gamble were among the few to post gains, with only 14 stocks to finish higher on the S&P index. Well, plenty of central bank action overnight as policymakers respond to rising global inflation. The Bank of England hiked its key lending rate by 25 basis points to 1.25%, its highest level in 13 years. But those who dissented in the decision voted for a more aggressive 50 basis point hike. Minutes from the Monetary Policy Committee meeting highlighted labour market tightness and a desire to tighten in the face of a weakening economy. And the Swiss National Bank surprised with a 50 basis point hike, taking its key lending rate to minus 0.25%, while indicating further tightening in coming months as it attempts to counter inflationary pressures. In US economic data, housing starts fell by more than 14% in May, which was more than expected, while building permits fell 7%. The Philadelphia Fed Manufacturing Index turned negative, although higher employment and faster deliveries pointed to an easing of recent constraints, but orders moderated. The number of Americans filing new claims for unemployment benefits fell less than expected last week, suggesting some cooling in the labour market, though conditions remain tight. Data reveals a steady rise in job cuts, mostly in the tech and housing sectors. And despite growing fears that the US economy is heading for a hard landing with the prospect of recession, President Joe Biden remains optimistic, saying a recession is not inevitable. Well, US bond yields had their largest fall in 3 months as investors turned to government debt amid a stock market sell-off. 2-year Treasury yields falling from 3.4 to 3.1%, while the 10-year fell from 3.49 to 3.25%. Markets are pricing the Fed funds rate to be 74 basis points higher at the next meeting in July and 200 points higher by the end of the year. And those falling yields have dragged the US dollar lower. The Aussie has climbed back above 70 US cents, while the yen has firmed on speculation the Bank of Japan could deliver a hawkish surprise today. So, to the local share market, and more heavy selling is expected today, with ASX futures down more than 2%. While global oil prices have risen after the Biden administration unveiled new sanctions against Chinese, Emirati and Iranian firms that help export Iran's oil. Iron ore futures fell for a 6th straight session as concerns about global demand deepen, exacerbated by central bank tightening. Base metals were mostly lower, with aluminium down more than 3% and copper also falling. And falling bond yields helped push gold futures higher, up 1.7% to $1,849 an ounce. And Bitcoin has fallen back towards the $20,000 mark. And that is your day ahead. We'll see you again on Monday.